Hi, I'm Greg Wallace, Senior Editor at Hotel Business. We recently had the opportunity to attend
the Rockbridge RTRX event in Columbus, Ohio.
Since 2011, Rockbridge and other members of the hospitality industry have raised more than $4 million to help fight cancer. While at the event, we sat down with some of the top executives in the industry for a roundtable to discuss what it takes to get a deal done.
Well, I would answer it a little differently because our motto is people credit real estate. So the people who we're doing business with is really important, making sure they're quality individuals and the companies are sound. Credit is looking at their balance sheet, making sure that they have the means to complete projects and don't get over their heads. And then the real estate, making sure that the real estate makes sense and it's able to cash flow and we're able to underwrite it and provide appropriate levels of debt.
At the risk of sounding funny, I think probably the top two deal breakers in any deal in our industry is probably debt and equity. The availability of debt, the availability of equity to get your deal done. And there's so many other things that kind of play into it. It could be flag, location, et cetera, but I think the top two deal breakers are deals don't get done because they don't have any availability of capital.
We arrange debt and equity transactions. The last 12 months, we've arranged probably pretty close to $10 billion of transactions. And the biggest issue in a transaction is unknowns. Anything that you thought you knew going into the deal, but turned out you didn't have the correct facts, that's what breaks the deal. So for example, if you underwrote X dollars of CapEx, and it turns out that the PIPs were significantly higher than you thought, or that the capital expenditures generally were higher than you thought, that's really one of the bigger issues in a transaction. Because going into the deal, you can underwrite the market, you can underwrite the asset, you can underwrite the economy. But if when you actually start due diligence, capital becomes usually the biggest issue in a transaction. And to the extent a buyer finds that the property needs more capital, that typically breaks the deal.
There's obviously lots of things that can break a deal, but the biggest thing is having great partners, putting a great team together from ownership to development to your architect and your design firm and your operator and your brand, and putting a great team together that has mutual goals. And that alignment makes good deals great and makes bad deals good. And so we really focus on who we're partnering with and do that again and again.
Our firm's an intermediary firm, so we represent sellers of assets or owners who need financing. So the top two is probably one for sellers and one for buyers. For sellers, it's that if the seller doesn't have clarity if they're going to sell or what they want an intended outcome to be, that is say, hey, let's go out and see where the market's at, that would be kind of a non-starter for us because you end up exercising the market and it creates actually a bad reputation for the seller besides wasting buyers' times and the market's time, what have you. So you have to have absolute clarity on where you're prepared to trade. So that's on the sell side. And on the buy side, I think it's one of integrity. Buyers who say, okay, I'll pay this price, and if they come back and retrade, then the next time you go to sell an asset, you're unlikely to recommend them as the winning bidder.